Hello folks, Steve Lenz here with Discover Options here at Option View Systems International. Welcome to this presentation of 3 different market timing reports for advanced options traders. This will be for Friday, February 23rd, getting ready for Monday, the 26th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started on these reports for advanced options traders, please subscribe. Click the subscribe button. We'd love to make sure you get those updates whenever we come out with new videos on this channel. Also, we have a free ebook for those of you that do not have it already. Just click the link, give us your info. We'll get this out to you. It's a book co-authored by myself and Jim Graham, Simple Steps to Options Trading Success. I think you'll find it very interesting. Let's go to the current market condition. This is what we will address for all 3 reports. And by the way, those 3 reports include the Condor Butterfly Timing Report for those of you that sell premium in a market neutral fashion. The Bull Put Spread Timing Report for the S&Ps for those that like to do credit spreads, hedged bull put spreads, etc. in the S&Ps. And then finally, the Directional Likelihood Report answers the question based upon past occurrences of our current market condition. What's the market likely to do? Go up, down, or wobble around for a bit? And when you look at the current market condition, all right, we can see that we are above the 65-day simple moving average. In terms of the stochastics, the 15-3 stochastic, we're at about 62 or so, so we're between 35 and 75, right around there. Actually, you know what? Those numbers are a little different. I'm going to scratch those. I'm going to make sure we get these right. These are actually, let me see here. I'm using the numbers 42 to 82. Yep, 20 points in either direction. And we're above the %D, 3-day simple moving average. This makes for a market condition that hasn't even occurred 100 times, all right, since January of 01. It hasn't occurred that much. Price action with all this is we have a downswing bar and then an upswing bar. Downswing and an upswing happening above the 65 with the stochastic between 42 and 82 trending upward. Okay, so all that makes for our current market condition. Let's go now to our first report. Okay, that's the Condor Butterfly Timing Report. So so since January of 2000, the S&Ps have had 4,575 daily closes. Now, of those 4,575, 64.9% have been favorable bars for selling options premium where the actual subsequent move was less than what the option prices were implying, the SIBO skew adjusted VIX, the implied movement. Okay, so once again, almost 2/3, 64.9% of the time, you have a situation where the ensuing movement is not as much as what the VIX is implying. Okay, so keep that benchmark figure in mind because that's over the course of, since Jan of 2000. Now, also since Jan of 2000, our current market condition has only occurred 45 times. Only 45 times. Now, of those occurrences, 62.2% of the bars have been similarly favorable for premium selling. That's less than our benchmark of 64.9. So we technically have a selling edge that's negative, a negative edge. And it's actually statistically, it's slightly more likely than usual that our current market condition will end up being an unfavorable one for market neutral option premium selling. Isn't that interesting? Okay, so that's for the Condor Butterflies. Now, does it mean you can't make money? Well, of course not. Okay, doesn't mean that. It just means that this market condition historically has acted up a bit more often than normal. That's all it means. Now, if you have a good way of trading condors and butters and you can adjust in those rough times, that's great. But just understand that in this current market condition, historically, it's been a little bit more active than normal going into this. So just go in with your eyes wide open. In terms of a bull put spread timing report, this presupposes you're going to sell put premium, a standard deviation out 30 days away, something like that. And so, of course, we've had 4,575 daily closes of the SPX. Of those, let me see here. Oh, I said 63.1. That's really 83. That's just a typo right there. 83.1. Of those, 4,575, 83.1, percent of the bars have been favorable bars for selling put premium, where the actual 21 bar downside movement was less than what the option prices were implying. And what we do is we use the SIBO skew adjusted VIX to get that implied downside movement. All right, so once again, 83.1% of the time, the market does not move down that full standard deviation 30 days out. That's what's being implied by the option price, is it fails to do it. Now, the rest of the time, 16.9% of the time, yeah, it does go down and strike that one standard deviation level. But that's the benchmark, historical benchmark. Our current market conditions occurred 45 times. Of those, 79.9% of the bars were favorable for put premium selling. Again, that's less than the benchmark by about 3%. So we technically have a selling edge that's a bit unfavorable. We have a negative edge. So statistically, it's more likely than normal that the current market condition will end up being an unfavorable one for selling out of the money put premium. Now, you can still put it on and still you're at about 80%. That's pretty darn good. So if you have a way of putting on credit spreads or selling that put premium where you could weather the storm, when it goes down against you and strikes that strike price, 20% of the time, well, that's great. And what we do here at Discover Options is we teach a hedged a bull put spread approach, where we put on an at-the-money bear put spread and then sell a whole bunch of out-of-the-money bull put spreads. Okay, and we talk about how to adjust those and exit and enter and all that fun stuff. And so that's something we teach in our curriculum that we're very proud of. Finally, let's go to the likelihood report, where we're looking at that market condition and asking ourselves, based upon that market condition and the fact that it occurred in the past, roughly 45 times, what's it likely to do in the future? Go up, down, wobble around for a bit. And so to answer that, we have to use what we call price distribution bands. And what you're seeing here are the 5-day bands set above the close and below the close. And these are set 5 days out, one standard deviation away, using the VIX skew adjusted numbers. And you'll note because of that, the out-of-the-money calls have lower IVs than the out-of-the-money puts. So we're a little bit closer to the close above, but a little bit farther away underneath. That's reflecting the vertical skew that we have in the S&P options. Okay, now what we're doing is we're taking a look for every close, and we're monitoring whether the market in the next 5 days goes up and hits the upper band, the lower band, or wobbles around and doesn't hit either band. And we keep those stats for the 5-day band, the 10-day bands for every close going back, and then also the 15-day band going back. And those are farther away, as you can see, way out here. That's 15 days away. 15 days away. So we go farther out in time and monitor whether it goes up, hits it, down hits it, or fails to hit it. Now, let's go to the statistics then. Here we go. When we look at the report, we can see of those 4,575, the upper 5-day band was struck 21.9, the upper 10, 16.4, the upper 15, 15.6% of the time. The lower bands, 5 was struck 16.4, 16.7, 19.5. That's the benchmark out of the history of the S&P 500 using the skew-adjusted VIX for those bands going back to Jan of 2000. That's our benchmark right there. All right, now let's go and look at those 45 times. Now 46 includes the most recent. But you can see that the upper bands, upper 5-day band struck 17.4. That's less than 21.9. So, you know, it failed to hit that upper 5-day band as often as just the benchmark history. And it did the same for the upper 5 and the upper 15. It struck those bands less often on the upside. On the lower bands, it struck the lower 5-day band less often by about 3.5%. It struck the lower 10-day band more often by quite a bit, by 5%. Struck the lower 15 less often. Altogether, we have a picture of lower market volatility altogether here when you add it all up. However, okay, let's go look at the instances where price exceeded, okay, the previous day's high. That happened 32 times out of 45. And when you look at that, you could see that roughly, well, this is a wash. But you have 3 of the bands getting struck less often, 2 of them more often, and 1 of them the same. 6 times the market went down and went beyond the previous day's low, Friday's low in this case. That's just not often enough to really write home about. So I'm not going to put any stock into these. And we had quite a few bars which were apparently, I'm going to say inside bars, because we have 32 plus 6 is 38. There were about 7 inside bars that are not accounted for in either of these rows here. Okay, throwing the stats a little bit off. But take a look at these 46, and we see a picture altogether of slightly lower market volatility with a little bit more action, and down here it's broken out a little bit. But yeah, that lower 10 is quite a bit, 5% more. It's enough to throw it so that we have a negative edge slightly in selling premium, either from a bull put spread or from a market neutral approach when you add it all together. Okay, very, very close though. But anyway, I hope these stats are helpful for you. I'm Steve Lentz with Discover Options. Have a great rest of the day and a great week of trading. Bye-bye.